You know what's strange? The moment you invest your first real $10,000, nothing looks different on the outside. Your job hasn't changed, your income hasn't exploded, your lifestyle is exactly the same. But internally, something shifts. And it doesn't shift because of the number alone, it shifts because of how you chose to set it up. Most people think the power is in reaching 10,000. I don't think that's true. I think the real power is in how you position that first 10,000. Because the way you set it up determines whether it becomes a foundation or just another number sitting in an account you'll second guess every time the market moves. When someone hits their first $10,000 invested, there's this temptation. You feel like you've earned the right to be clever. You start thinking, maybe now I can pick stocks. Maybe now I can find the next big winner. It feels almost boring to just put it into broad market funds. You've done the hard work of saving. Surely this is the stage where you try to accelerate. But here's the uncomfortable truth. Acceleration without foundation is fragility, and fragility is what destroys compounding. So when I talk about perfectly setting up your first $10,000 invested, I'm not talking about finding the highest possible return this year. I'm talking about building something that will still be standing 10 years from now, 20 years from now, 30 years from now. And the simplest way to do that, the most boring way, the most unexciting way, is through low-cost, broad market index funds and ETFs. Not because they're flashy, not because they make great headlines, but because they remove the single biggest risk in investing, you. Broad market index funds and ETFs, especially those offered by providers like Vanguard, BlackRock through its iShares ETFs and iShares itself, do something powerful. They eliminate the need to guess. Instead of asking which stock will outperform, you're saying, I'm owning the market. You're accepting the average return of the market over the long term. And historically, that average has been remarkably consistent. Over many decades, broad U.S. stock market returns have averaged roughly 8 to 10% per year before inflation and around 7% after inflation when you account for purchasing power. That may not sound extraordinary in a world obsessed with doubling money overnight, but over time, that quiet average compounds into something extraordinary. Think about it this way. At a 10% average annual return, money roughly doubles about every 7 years. At 7%, it doubles about every 10 years. That's not speculation. That's mathematics. And when your first $10,000 is set up to quietly earn the market average instead of being thrown into volatile bets, you're not chasing upside, you're building predictability. And predictability is what allows compounding to work without interruption. The reason this setup changes everything is psychological before it's mathematical. When your first $10,000 is diversified across hundreds or thousands of companies through ETFs that track the entire S&P 500, total market funds, or global indexes, you don't wake up panicking because one earnings report missed expectations. You don't feel the emotional urge to sell because one CEO stepped down. You're not tied to a single narrative, you're tied to the overall growth of the economy. That emotional stability matters more than people realize, because the biggest returns in investing don't come from picking the perfect stock. They come from staying invested long enough for compounding to do its job. Most people underestimate how destructive volatility feels when you're concentrated. If your entire $10,000 is in one or two stocks and they drop 30%, that feels catastrophic. Even if you intellectually know markets fluctuate, emotionally it feels like you made a mistake. And that emotional discomfort is what pushes people to sell at the worst times. But when you're broadly diversified through low-cost ETFs from Vanguard or iShares that hold hundreds or thousands of underlying companies, a 30% drop in one company barely moves the needle. You feel the overall market's ups and downs, yes, but you're not exposed to a single point of failure. That's why building a safe base matters. It's not about playing it small. It's about building something anti-fragile. When your first $10,000 is sitting in broad market index funds or ETFs with extremely low expense ratios, tracking entire economies rather than individual stories, you're aligning yourself with long-term growth instead of short-term noise. You're saying, I don't need to be smarter than everyone, I just need to be consistent. And consistency is what creates margin. When your investments are set up in a way that doesn't demand constant monitoring, you create mental space. You stop refreshing stock apps every hour. You stop obsessing over news cycles. Your role shifts from active gambler to patient owner. That shift alone changes how you relate to money. Instead of feeling like you're constantly defending it, you begin to feel like it's quietly working in the background. Now, let's talk about why this becomes such a powerful platform. When your base is secure, yet when your core $10,000 is invested in diversified, low-cost ETFs or index funds that capture the average return of the market, you have something solid to build on. Compounding works best when it isn't interrupted. If you chase high-risk bets early and suffer large losses, you don't just lose money, you lose time. And time is the one ingredient you can't replace. A 50% loss requires a 100% gain just to break even. That recovery time is expensive. By contrast, if you accept average returns and let them compound steadily, you're stacking incremental growth on top of itself year after year. 10,000 becomes 15,000. 15 becomes 20. 20 becomes 30. And because those gains are layered on a diversified base, the volatility feels manageable. You're not riding emotional roller coasters, you're riding long arcs. There's also something else that changes once you set up your first $10,000 properly through ETFs from providers like Vanguard or iShares under BlackRock. Your identity shifts. You stop seeing yourself as someone trying to get rich quickly. You start seeing yourself as someone building long-term capital. That subtle change affects every decision that follows. When new money comes in, you don't ask, "What's the hottest stock right now?" You ask, "How does this strengthen my base?" And over time, that mindset compounds just as much as your returns do. Eventually, yes, you can branch out. Once your core is strong, once you've built a meaningful base that represents broad market exposure through diversified ETFs, you can allocate a small portion toward individual stocks or higher risk opportunities if you choose. But those become satellites around a stable core. They're experiments, not foundations. And that distinction protects you. Because if one experiment fails, your core continues compounding. Think about how different that feels compared to someone whose entire portfolio is built on concentrated bets. Every market downturn feels existential. Every headline feels urgent. That constant emotional turbulence doesn't just affect returns. It affects your life. It bleeds into your work, your sleep, your relationships. But when your base is diversified through broad index ETFs, tracking the total market or global markets, downturns feel like part of the process, not personal failures. This is why the first $10,000 matters so much, not because of the number itself, but because it's the moment you decide what kind of investor you're going to be. Are you going to build slowly, deliberately, accepting average returns that historically have built extraordinary wealth over decades? Or are you going to chase outperformance, knowing that most professional managers fail to consistently beat the market over long periods? When you choose the broad market route, often through well-established ETF providers like Vanguard and iShares by BlackRock, you're acknowledging something humble but powerful. You don't need to win the game in a single year, you just need to stay in the game long enough. And historically, the market has rewarded patience. Over long time horizons, despite recessions, wars, crashes, and crises, diversified stock markets have trended upward. Not smoothly, not predictably in the short term, but persistently in the long term. That persistence is what you're buying when you invest in broad index funds and ETFs. You're buying participation in innovation, productivity, and global growth. You're buying ownership in thousands of companies working to increase profits, expand markets, and improve efficiency. You're aligning yourself with the engine of economic expansion rather than trying to guess which single piston will fire the hardest next quarter. And once that engine is running beneath you, everything changes. Because now your future wealth is no longer dependent solely on your labor. It's connected to capital. Even if it starts small, it's there. Working quietly, growing steadily, compounding invisibly. The irony is that the perfect setup feels almost anticlimactic. There's no dramatic spike, no immediate transformation, just a calm, deliberate allocation into diversified, low-cost ETFs from trusted providers like Vanguard or BlackRock's iShares, automatic contributions, and time. But that calmness is the point. Wealth built on stability feels different from wealth chased through volatility. It feels grounded. So if you're standing at your first $10,000 invested and you're wondering what the perfect setup looks like, it's not complicated. It's broad market exposure through diversified ETFs. It's low fees. It's diversification across sectors and industries. It's resisting the urge to concentrate. It's understanding that average returns compounded for decades beat sporadic wins interrupted by large losses. And once you do that, once you lock in that structure, You stop worrying about whether you picked the right stock this month. You start thinking about decades. You start measuring progress in years instead of days. And that long-term lens changes your behavior. You save more consistently, you invest more regularly, you become less reactive. That's the real shift. The number is just the catalyst. The structure is what determines whether that catalyst ignites something lasting. Your first $10,000 invested isn't about proving you can outsmart the market. It's about proving you can commit to a process. And when that process is built on diversification, low costs, broad exposure, and simple ETFs, tracking entire markets through firms like Vanguard and BlackRock's iShares, you're not betting on luck. You're betting on growth itself. And that's why setting it up correctly changes everything. Not because it guarantees extraordinary returns tomorrow, but because it builds a foundation that makes extraordinary long-term outcomes possible. From here, compounding takes over. Growth layers upon growth. Dividends reinvest. Market expansions lift your base. And over time, the quiet average return does what it has historically done. It builds capital for those who remain invested. And here's the final layer that most people miss. When your first $10,000 is structured this way, every additional dollar becomes easier to allocate. You're not reinventing your strategy each time you invest. You're simply adding to a system that already works. That simplicity reduces decision fatigue. It reduces doubt. It removes the emotional friction that often prevents people from investing consistently. Instead of wondering whether now is the right time or whether this stock is the right pick, you continue contributing to a diversified ETF portfolio that mirrors the broader economy. Over time, that discipline compounds into confidence, and confidence compounds into scale. As your base grows, is 20,000, 50,000, 100,000, the power of that early structure becomes even more obvious. The market's average return, which once felt small on 10,000, now produces meaningful annual growth. The same 7 to 10% that seemed modest begins generating thousands of dollars per year. And because you built the foundation properly, those gains feel earned and sustainable rather than fragile and lucky. Simple, boring, powerful. And once you understand that, once you internalize that your first $10,000 invested through diversified ETFs from firms like Vanguard or BlackRock isn't the finish line, but the beginning of disciplined ownership, you stop chasing. You start building. And that's when everything truly changes.